Most people think you have to put 20% down to buy a home, but that's not true. In fact, many buyers put down much less and still get into the house fast. But what's the real difference between putting 20% down versus 3%, 5%, or 10%? Let's break it down. A down payment is the portion of the home's purchase price you pay up front in cash. If a house costs $400,000 and you put down 20%, that's $80,000 in cash at closing. Pay less, like 3% or 5%, and your mortgage amount is larger. Contrary to old school advice, you don't have to put 20% down to buy a home. Many loan programs allow much lower down payments. Conventional loans as low as 3%. FHA loans as low as 3.5% down. USDA and VA loans 0% down for qualified buyers. In fact, the median down payment for first-time home buyers in the U.S. is around 9%, not 20%. Putting 20% down has some clear financial perks. Avoid private mortgage insurance, which is known as the PMI. Most conventional loans require PMI if you put down less than 20%, which is an extra monthly cost and added to your payment. Lower monthly payments, you borrow less money, so your monthly principal and insurance or interest goes down. Better loan terms, lenders often offer lower interest rates to buyers with more equity at closing because it reduces their risk. And then instant equity. Starting with more ownership in your home means more financial stability and quicker access to future options like refinancing or a HELOC. Putting 20% down isn't always the right move for some. Lower down payment may be smart when you want to buy sooner rather than waiting years to save. Waiting to save 20% could mean paying more in rent and missing out on a market appreciation. You want to keep cash reserves for emergencies, renovations, and furnishings. You qualify for special programs that let you put down very little or even zero down. It's a trade-off, higher monthly payments and a PMI versus getting into a home now. Let's look at a simple example. $400,000 for the home price, 20% down, which we've already talked about, is $80,000 down. Smaller loan, no PMI, lower payment. 5% down is $20,000 at closing. Larger loan, PMI, and higher payment. The numbers change based on your rate and loan type, but the principle is the same. A bigger down payment equals less risk plus lower costs over time. So there's no one size fits all down payment. What matters most is how much you can responsibly afford without sacrificing your financial stability. In the end, choosing the right down payment isn't about hitting a rule. It's about building long-term wealth and peace of mind.